Welcome back to the Money Seed Podcast. Today I have a brief video about 401ks versus non-401k investments, right? And I wanted to make this video because in episode 22, I spoke with Chris Odegard, author of the book, Get Off Your Ass and Manage Your Money. And in that episode, Mr. Odegard clearly said, look, if you're putting money in 401ks, stop it and invest your own money and you'll be better off. Again, this is not financial advice. All I want to do here is just to have a really simplistic model, compare what happens when you put your money in a 401k, what happens if instead of doing that, you pay taxes on it and then you invest it outside of a 401k. All right. So apples to apples here. Let's just come up with a very simple mathematical model. Assume you are investing $10,000 a year. And we're going to take some assumptions about what your income tax rate is while you're working, what your income tax rate is going to be in retirement, what your long-term capital gains taxes are, and how much your company is matching your 401k. All right, so let's start off comparing three different scenarios, apples to apples, right? So you're going to invest $10,000 in a 401k without any company match, just $10,000. Second scenario, you're investing $10,000 into the 401k and your company matches 25%. So it's going to be another $2,500. So you're going to put in $12,500 a year into that 401k. And the third option is you pay income tax on the $10,000, right? Which in this case is $3,500. So you're left with $6,500 cash after tax money and you invest that into whatever investment you want, but not in a 401k. And let's see which one of these wins. Now, in this case, there's a clear winner because we are comparing apples to apples, right? We're assuming a growth rate of 8% regardless of where you put your money because you're putting your money in the exact same mutual fund or index fund or wherever that may be, right? And in this case, the winner is clearly the 401k, even without the company match, right? The clear winner is the 401k. So what happens is after 20 years, you are going to have a balance of about $500,000 in the 401k, about $630,000 in the 401k with the company match, and about $327,000 in just your regular account. Now, that may seem like the 401k is, much bigger. In the second case, it's twice as much. But remember, the taxes are different. In the 401k, you are shielded from the capital gains, but you have to pay income tax. Whereas in the regular investment, you are only paying capital gains because you've invested after tax money. So the taxes work out a little bit differently, but still the clear winner is the 401k. So what happens here is very simple. Let's just take a 4% withdrawal, right? That's the 4% rule. In theory, mathematically, you can take that out forever. I think before the age of 75, you can take out as little as 4%, and your base capital should never decrease, right? Because in theory, you can take out 4% forever, in theory. So basically what happens is after you pay your taxes, you're going to get about $15,000 from the 401k, $18,000 a year if you got the company match of 25%, and only $11,000 a year from your regular investment outside of the 401k. Again, 401k is a clear winner, but Chris is a very smart guy. So what did Chris talk about? Well, what he was saying is, look, if you're going to put in a 401k, like most employees in America, you usually typically don't have much of a choice, right? Your company auto enrolls you. They put you in some, fund, whether it's a growth fund or a balanced, portfolio or an index fund. And you're probably only going to get maybe 7% or 8% after fees, etc. However, if you can invest your own money after you pay taxes, you can invest in whatever you want. And there are a lot of tax, different tax strategies when you invest outside, etc. But let's say you are a good real estate investor and you can get 13% return a year on your real estate investment, right? And remember, you can't do that inside your company-sponsored 401k. But let's say you are a really good, savvy real estate investor and you're getting a 13% annual return on your money. Very possible, all right? If that happens, all of a sudden, look at that. Your investment outside the 401k does better, right? Your portfolio grows to $601,000, which is slightly less than the 401k with company match, but the taxation is different, right? Now you're paying capital gains tax, and after the after taxes, etc., you're left with about $21,000 versus $18,900 for the 401k with company match. And it's way better than the $15,000 you get with a 401k without the company match. So in this case, if you got 13%, you are doing better than the 401k with the company match. You also have a lot more freedom with the money. Whether you want to, there's going to be some cash income from the properties. There's going to be some capital gains if you sell a property. I mean, you have just a lot more freedom in how you move the money around, etc. However, the 401k also has some advantages. Some 401ks are sheltered in case of bankruptcy, etc. But if you're wondering how that all works out, that's how it works out, because Chris is a very good and experienced real estate investor, and he can consistently get more than 7% or 8% that you get in a mutual fund. With real estate, you can get 13%. Now, some people can leverage real estate and get another kind of real estate deals. They can get 15%, right? In which case, it's a slam dunk. In other cases, some investors can even do better. But even if you say 13% from real estate, you're winning. Now, some people say, hey, your company match is more than 25%, right? If I bump up the company match to 50%, if you are fortunate enough to work for a very good employer that has good benefits, that can match up to 50%, then all of a sudden it becomes very close. And a company match with 50% might give you a slightly higher retirement income than a 13% real estate deal. But again, if you are looking at a 15% return on your real estate, then again, that's a clear winner. So it all depends on how comfortable you are and how confident you are with real estate investing or any other type of investment. Maybe you want to pump this money into a business. Maybe you want to get into some other type of crypto, or if you are confident that you can do much better than the 8% that your 401k is going to give you over, say, 20 years, you might want to consider what Chris is saying. Again, not financial advice, talk to your financial advisor, etc. But in case anyone was curious about how the math works out, that's how the math works out. And this is why Chris is choosing this route. All right. Thanks for watching. If you like this video, comment, let me know what you think. If you think my math is off or my model is wrong, let me know. If you want me to send you a copy of this sheet, let me know. Drop your email in the comments or reach out to me at themoneyseedpodcast@gmail.com, and I'll send it right over. All right. Thanks.